Welcome to TradeTheNBI.com. This is John. This report is for the 2nd of January 2018. And what we're looking at here is a condensed chart showing the entire, last year. And you can see we began right in this 2260 range. And it's just a slow, steady incline throughout. Really started picking up towards the later half of the year once it was realized that those early transformations that took place after Trump took office began to have an impact and really started to accelerate, and that acceleration will probably begin to continue. Now, we caught some serious little points here where things got a little bit extended. We're going to continue to get that, and these drops, not really significant percentage-wise, particularly as they've come in, they've pretty much stalled out. The most interesting one we were talking about here when we broke out on the ABM, let me even go a little bit bigger here and we'll show these last, since like November when we started getting a little bit parabolic here at the end of the time frame. Right about here was right around the 26. We had about a 26.30 to 50 range expectation overall for the year finish. We ended up going a little bit beyond that, got right up to that 2700, but we knew that that was going to be resistance and that we would probably come back into it, and we got up to that 2698. They made a push forward at the end again for those that were late trying to get return, but like we talked about with year end, they would want to sell into that little push to finalize their window dressing for year end, and it's exactly what happened. It created a significant DOC spread as well as a huge spike in the orange. The only benefit to this situation was the fact that you had steel reset, but that's also dipped below 13.5, which is effectively coming from up above. It needs to pivot back up. So you've seen a huge draw out of midterm, short-term buyers. Hasn't moved long-term buyers into the negative yet, but we're quickly approaching the ABM levels right there at the 59 range in that, and I wouldn't be surprised to see us move back towards the 50 or even the 2630 range as rebalancing takes place in there, and it just fills back the positive extremes right there. We're already taken care of, but we still have a couple from back over here. They were filled in by these dips, and the last ones being these right over here, which effectively were like intraday resets that took place there. So there's nothing required in the midterm for a reset value, and so this is where once you get to below the ABMs is when I like to look at the Fibonacci fib level retrace program that we have, because it becomes very effective as to seeing when you have a reset and you're at a critical level, which is usually right around that 50% range, or a dip that takes you all the way from zero coming back up above the 23%. And that's an extraordinarily effective approach. And you can see here, NASDAQ has completely retraced the pop-up mode, and it did do the move right to the ABM green, dip below it, and then as soon as it dipped below it, came right back up to even with it. So little poor situation though for the NASDAQ, though it will be oversold quicker than the S&P, which is not a surprise. It's been in a steady decline comparatively. When you look at these shakeout readings, you ended up with higher highs, lower shakeout reading, and then you started to get your DOC spread that took place. Well, it was right in here, right after the holiday. Oops, didn't mean to move that. I was just trying to show that we started a holiday in between the break right there for Christmas, and then it just continued cascade. And again, we didn't really worry about it so much, simply because you knew that there was going to be that year-end portfolio switch. The euro rise, though, is also bolstered and helped things. This is really a heavy move for the euro in pushing up, despite the really systemic problems, and it's a pretty strong move from the lows back down here. We ended up with the dip right here, we then ended up with the cyan under red, and it's taken off all the way from this 117 point. Now, will that continue? It looks to continue. I would expect that we might even move into the 122 range with the euro, which still is way outside what it should be. The dollar fade is an interesting thing given the fact that you have the U.S. growth at what it is. you don't have anywhere near any of that close to it in Europe. So it's very interesting. I call it central government intervention in trying to push it. It helps the U.S. As far as exports and everything else, makes it a little tougher for the Europeans, but that's been the case ever since the Fed has been active in European liquidity. So that's a whole different story. We don't even need to worry about it at this particular point, because with U.S. growth, what it is, even a dip in the euro is still not going to impact U.S. growth at this particular point. Interest rates will be the key going forward for the U.S. and oil. So, coupled with that, bonds, now, if you get a continued rate increase, there will be more interest there, but we may even be seeing a reflection that there's going to be just a pause, a no action. And a no action would actually be an even bigger boost to the economy, because being behind, as I discussed before, the macro view, if the Fed stays behind the curve on inflation and the move, then you'll actually see the market progress further, because the market will pre-price inflation, and some of this growth and everything in the value has been what I've been talking about, change in the multiple of the market, in that a lot of people just couldn't recognize, because they couldn't see the difference between a stagnation viewpoint of growth and modest increases to a pro-growth active return, and that automatically increases the multiple, and that's what's been priced into the market ever since Trump got elected. Changed the whole dynamic of where that's going to go, and so people are looking at some of the older dynamics, or don't remember, haven't been around long enough is another issue, don't realize why. And so, as I referred to you back to the 90s, post-Clinton, 93 range, the chart started to look almost the same as that period of time. Maybe I'll even do a comparison analysis to show you what that looked like, because it was just a slow grind, a little bit at a time. Didn't seem like anything dramatic, but it was just this constant little ebb rising. Now, oil, again, becomes a key factor, because if it reaches, I think, looking at USO here, if we get into the 13 or 14 range, then you could be seeing some definite signs of inflation that certainly would impact expectations for the market. And I think this is where, coming in the year, we're going to start to see some more gyrations, where it was a fairly simple call in 2017. I think that it's probably, we're going to see a bit more swings. Drawdowns could even be in spring in that, where we see significant pullbacks. Doesn't mean that we're still not in a general higher tone. It's just there's going to be some uncertainty about return and where you can get it, because if rates do rise a little too soon, then there will be advantages to going back to treasuries for a return versus equities, and that could be a realignment that will have an impact. And we're already seeing gold being pre-priced into that. So we had the buy coming all the way back down here at the bottom of this move, and we've eclipsed that. And as I talked about before, when we were right in the midst, actually shrink this, of the dip that took place, we were expecting gold to make a resurgence. Coming back, we had this peak, we were coming off, and I said, no, when we get down to a point where we get oversold again, we could have some buys. We had a couple of little pops, but again, the problem was we had dips below the red line that needed to be retraced, and when it did it right here, we were just waiting, and we kept getting these no spark, nothing in the oversold, and it wasn't until this most recent sell signal that happened up here at the peak of the ABM, right up there to, that was in the 122 range, and then boom, we started to take the plummet, and then we got super oversold. Now, we didn't expect this run to continue indefinitely because of the dip below the red line, but the reality of what happened was we just kept having rising green, and then we broke into new zones with the red, which was the next catalyst to driving it, and you ended up with another buy signal happened right at about here, and boom, with the orange below the DOC red, and then we got the cyan under red, which indicates that longer term run. Plus, now we're getting up there, though, from a shakeout standpoint, so I think that we're probably reaching that point where we can see that we're finally overbought on the extremes, and we might see a little bit more of a fill-back retrace to it. But needless to say, it's an indication that the market is starting to normalize itself and pull away from basically the quantitative easing manipulation of it. And I think that is going to add to volatility in a way that some people may not quite be expecting for the new year coming up. So here was what we had for the action leading into the final year. We had this pre-market pump, and I was telling everyone right at that particular point, I expect that maybe to fall back. We ended up with the push rate here above the 13.5, and then it was the next bar when we got to the ABM yellow that we broke below, and that was really your key point. If you didn't use the fib level higher, the 76%, if you highlight over these, you get the window to pop up, and you just hold the left, and there it is. The 76.4 was at 26.94 range, and once you broke below that, there was never any question back. We hit the 50%, and all you could see was rising short interest and a complete breakdown. You did have a reset of the steel right here, but the problem was your reset of the steel came at the point where long-term buyers are fading out of it. So that's not going to be a support factor at that particular point, which lets you know that you can stay with your short. It wasn't until we ended up down here, we got oversold, but you can see at that point, you had no steel reset. And you can see no steel reset throughout any of this, despite the oversold nature. The closest thing you had was the beginnings of a turn that was about to start right there. You knew you needed the reset of the extreme histogram, the dip below, and you never even closed above the 23%, which is just always a great indication that you're not going to get too much of a rally going back through. And sure enough, finished all the way down at the lows. 2660 is still pretty good. I thought maybe 2650 would have been right around the range, so it still ended up a little bit better than my expectation from that standpoint. But overall, I think very healthy action, and I think this is the precursor to starting up the new year. If we squeeze this out, you can see that there really wasn't a whole lot of action for quite a while. I mean, we've been pretty much basing up and around there, and you have to go all the way back here to the 15th of December to get back to below where when we started that peak move. And the key level I was really kind of looking at was in the 70-something range that we just went slightly below it on this most recent. That's kind of the last little support until we get well, right down here in the 65 range, and then it's going to be, all the way back to the 50. So that's kind of what I thought would be a full reset move, but didn't quite go all the way, and that's all right. Not an issue with that. So overall, looks like we're going to have a little bit more weakness going into the start of the year, which I don't think is too problematic. I think it would probably be a healthy way for people to think that they're getting a discount to where things have been trading, which is okay. Adjustments to the indicators and all that will be coming out with for the new year. So those will be going out later on New Year's Day, so that everything's set for the beginning of the year. We're looking forward to an exciting one going on. As always, though, I hope everyone had a Merry New Year, and we're ready to rock and roll for the next one. So get ready for it. As always, though, trade well.